Look, I need to talk to you about something that has been developing in the precious metals market that I think represents one of the most significant technical and fundamental setups I have seen in my entire career. If you own gold or silver, if you're thinking about precious metals exposure, what I am about to share with you is critical for understanding where we are in this cycle and what could happen over the next 12-24 months. I'm Raoul Pal, and I've spent decades analyzing global macro trends and technical patterns across asset classes. And what's happening right now with the gold-silver ratio combined with the supply-demand fundamentals we've been tracking is creating a convergence that could lead to explosive price action in silver, the kind of move that happens maybe once or twice in a generation. Before we dive into the specifics, hit that subscribe button because the analysis I'm about to share connects technical breakdowns, supply constraints, industrial demand acceleration, and historical patterns in ways that mainstream commentary is completely missing. This is institutional level thinking about a setup that's still flying under most people's radar. Let me start with the gold-silver ratio because this is the key to understanding the magnitude of what could be coming. The ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Right now we're sitting around 85-1. Historically, that ratio has averaged somewhere between 40-1 and 60-1 over the long term. We've seen extremes where it spikes to 100-1 or even higher during severe risk-off events, and we've seen it compress to 30-1 or lower during commodity booms. But here is what is critical. The ratio recently hit an extreme high around 125-130 before breaking decisively lower, that break the move from 130 down through 85 and now testing lower levels. That's not random noise. That's a major technical reversal pattern completing, and when these kinds of patterns break, after multi-year setups, the moves can be extraordinary. From a pure technical standpoint, if this ratio continues compressing toward historical averages, let's say 40-1 or 50-1, and gold stays at current levels around 2700-2800, silver would need to be at 55-70 just to normalize the ratio. But here's where it gets interesting. In late-stage bull markets, ratios don't just normalize, they overshoot, they go to extremes in the opposite direction. If we get a true commodity mania, if silver becomes the focus of speculative and investment demand the way it did in 1980 or 2011, could see this ratio compress into the 20s or even lower. At gold $3,000 and a ratio of 20-1, silver would be $150. At a ratio of 15-1, which has happened historically, silver would be $200, and if we get a parabolic blow-off where the ratio overshoots to single digits, even temporarily, you're looking at silver prices that most people would consider absurd today but might feel inevitable in the moment. Now, I'm not making a prediction that silver goes to $200 or $500 or any specific number. What I'm saying is that the technical setup combined with the fundamental backdrop suggests we're at the beginning of a major repricing event, and when these events unfold, the magnitude of the moves often exceeds what anyone anticipated at the start. Let me talk about the supply-demand fundamentals because this is what gives the technical setup teeth. Silver is unique among precious metals because it has this dual nature. It's both a monetary metal with 5,000 years of history as money, and it's an industrial commodity that's absolutely essential for modern technology. We're running a structural deficit where global consumption exceeds mine production by 150-200 million ounces annually. We've been filling that gap by drawing down above-ground inventories, but those inventories COMEX registered silver, London vaults, Shanghai stocks, they're all at multi-year or multi-decade lows. The physical market is getting very tight. And here's the critical point. Roughly 70% of silver supply comes as a byproduct of mining other metals: zinc, copper, lead, gold. Primary silver mines are rare. This means silver supply doesn't respond quickly to price signals the way other commodities do. Even if silver doubles, copper miners aren't going to ramp up production. Just for the silver byproduct, the supply is structurally sticky. Meanwhile, demand is accelerating from multiple directions simultaneously. Solar panels require 20-30 grams of silver each, and solar installations are growing 20-30 annually. EVs use 2-3x more silver than traditional cars. 5 grams infrastructure, AI data centers, electronics all require silver. And now we're seeing solid-state battery technology entering commercialization, which could use up to 1 kilogram of silver per vehicle compared to 30 grams in current EVs, if just 20% of EV production shifts to solid-state batteries over the next 3 to 5 years. That alone could consume 150,000 metric tons of silver annually. That's nearly 25% of total global mine production just from one technology shift in one industry. Layer that on top of existing solar, electronics, and traditional demand, and you have a supply-demand imbalance that's mathematically unsustainable at current prices. This is where the technical setup and the fundamental setup converge. You have a ratio breaking down from extreme levels, signaling a major shift in relative value. And you have a physical commodity where consumption is outpacing production with no quick supply response possible. When these two forces align, you get explosive repricing events. Now, let me talk about timing and how these moves typically unfold, because this is where most investors get it wrong. Parabolic moves in commodities, and silver is the most volatile of the major commodities. They don't happen in straight lines. They happen in waves with violent pullbacks that shake out weak hands before the next leg higher. The mathematics of parabolic moves is well established. The majority of the gains happen in the final phase. If silver goes from $30 to $150 over a multi-year cycle, the move from 30 to 80 might take 18 months with lots of volatility and false starts. But the move from $80 to $150 might happen in 3-4 months in a buying panic. The last 5-10 of the time period produces 40-50 of the total price gain. This creates a psychological challenge. Most investors sell too early. They catch the first wave from $30 to $60. They're up 100%. They take profits thinking they've captured the move, but they miss the acceleration from $80 to $150 where the real wealth is created. Understanding this pattern, recognizing that the final phase is both the most profitable and the most uncomfortable, is critical for capturing the full opportunity. From a macro perspective, we're in an environment that's increasingly supportive for hard assets. Central banks are trapped between inflation concerns and growth fragility. Real rates are barely positive. Fiscal deficits are structural. Currency debasement is ongoing across all major economies. In that backdrop, assets that can't be printed and have genuine utility become increasingly valuable. Gold has already reflected this. It's at all-time highs. Positioning is heavy. Sentiment is bullish. Silver is still catching up. It's undervalued relative to gold, and most investors don't even have it on their radar. That positioning asymmetry means when capital starts rotating into silver, there's limited supply to absorb the buying pressure. That's what creates explosive moves. So how do you position for this? How do you structure exposure to capture the opportunity while managing the risks? Because silver is volatile, it can drop 20-30 in a matter of weeks just to shake out weak hands before resuming higher. First, position sizing matters. This isn't an all-or-nothing bet. If you're currently holding gold, consider rotating 15-20 of that position into silver. You're playing the ratio compression while maintaining precious metals exposure overall. If you're allocating fresh capital, maybe 5-7 of a diversified portfolio into silver makes sense enough to matter if the thesis plays out, not so much that volatility forces emotional decisions. Second, think about entry strategy. We're not at the beginning of the move. Silver has already rallied from the lows, but in the context of where it could go, current prices may still represent the early innings. Rather than trying to time a perfect entry, consider dollar cost averaging over 3-6 months. You'll catch some dips by some highs, but you'll build the position systematically without the pressure of getting the timing exactly right. Third, diversify your silver exposure across vehicles. Physical silver gives you direct ownership, but comes with premiums and storage issues. ETFs provide liquid price exposure. Streaming and royalty companies offer leveraged exposure with cash flow. As silver prices rise, their margins expand exponentially. High-quality primary silver miners offer maximum leverage but come with operational risks. A balanced approach might be 40% ETF, 40% streamers, 20% miners. Fourth, and this is critical, have an exit framework. Don't anchor to specific price targets like $100 or $200. Those numbers are arbitrary. Instead, watch the gold-silver ratio. When that ratio compresses to 30-1 or 25-1, that's your signal that we're getting into late-stage mania territory. That's when you scale out of positions, take profits, reduce exposure. Also watch momentum and sentiment indicators. When silver is on the cover of mainstream financial publications, when your relatives who never invest are asking about silver, when premiums on physical metal are 50% over spot because everyone is panic buying, those are signs we are approaching a top, not the exact top, but the zone where you want to be reducing risk, not adding. Now let me address the "is it too late" question, because I get this constantly. If silver is going to $150 or $200, does current price around $30 matter? The math is straightforward. The risk-reward from 30 to 150 is 5-1, assuming you can lose 30 but make 120. That is attractive. Yes, you could get a better entry on a pullback to 25, but what if that pullback doesn't come? What if the move accelerates from here? This is where understanding multiple timeframes helps. On the monthly chart, silver looks extended with no obvious pullback zone. On the daily or weekly chart, you still get volatility and brief corrections. Those are your entry opportunities. You don't need to buy the bottom. You just need to participate in the larger trend. And here, That's the thing about late-stage commodity bull markets. Pullbacks become shorter and shallower as the move progresses. In the early stages, you get 30-40 corrections. In the middle stages, 15-20. In the final stage, pullbacks might only be 5-10 before the next leg higher. Waiting for the perfect entry means potentially missing the move entirely. Let me talk about the supply crisis that is building, because this is what could turn a normal bull market into an extraordinary one. As I mentioned, most silver comes as a byproduct, but there's another dimension: decades of underinvestment in mining. When silver was trading at 15-24 years, it wasn't economic to develop new primary silver projects. The capital didn't flow into the sector. Now we're facing a situation where demand is surging, inventories are depleting, and there's no easy supply response. New mines take 7 to 10 years from discovery to production. Even existing mines can't just flip a switch and double output. The supply inelasticity is extreme, and here is the kicker: if solid-state batteries really do require 1 kilogram of silver per vehicle, and global production is targeting 30-40 million units annually by 2030. That's 300,040,000 metric tons of silver demand just from batteries. Current global production is 25,000 metric tons. One technology alone would consume more than 100% of supply. That math doesn't work. Something has to give. Either prices rise dramatically to ration demand and incentivize recycling and substitution research, or the technology deployment timeline extends because metal isn't available. Most likely, it's some combination. Prices rise substantially, which slows adoption at the margin while accelerating supply responses. But that supply response is years away. In the meantime, we get a repricing event. This is why I think the setup is so compelling. It is not just a technical pattern or a ratio play or a supply squeeze. It is all of those things converging simultaneously. When you get that kind of alignment, the moves can be spectacular. Now let me address the risks, because every thesis has risks. The primary risk is recession with collapsing industrial demand. If global growth falls off a cliff, EV production collapses, solar installations stop, industrial demand for silver craters. In that scenario, silver would likely underperform gold significantly as investors flee to pure monetary assets. My view is that governments will respond to any recession with massive fiscal stimulus focused on infrastructure and green energy, both silver-intensive. So even in a recession, silver demand might hold up better than historical patterns suggest, but it's a risk you need to acknowledge. The second risk is technological substitution. What if cheaper alternatives to silver in solar or batteries get developed? What if recycling becomes more efficient? These would reduce demand pressure and weaken the thesis. You have to monitor the technology landscape and be willing to adjust. The third risk is government intervention. If silver prices spike too much, governments might impose export restrictions, price controls, strategic stockpile releases. We've seen this playbook with other strategic commodities. It's a tail risk, but it's real. The way you manage these risks is through position sizing and diversification. Don't bet the farm on silver. Keep it as a meaningful but not dominant position in a diversified portfolio, and stay informed if the fundamental thesis breaks. Be willing to exit even at a loss rather than marrying the position. Let me paint the scenario I think is most probable over the next 12-24 months. We're currently in what I'd call the recognition phase. Sophisticated investors and technicians are seeing the setup, but it's not mainstream yet. Over the next 6-9 months, as the gold-silver ratio continues compressing and as supply tightness becomes more apparent, media coverage increases, more capital starts flowing in. By mid to late 2026 or early 2027, we enter the acceleration phase. Silver breaks through key resistance levels: $50, $60, $75. Each break brings in more momentum traders, more systematic funds, more retail FOMO. Premiums on physical metal expand. Delivery delays increase. Industrial users start panic buying to secure supply. In the final phase, which could be late 2027 or 2028, we get parabolic. Silver might move 50100 in a matter of months. The gold-silver ratio compresses into the 20s or lower. Everyone who doubted the move is now rushing in. This is where fortunes are made, but also where discipline matters most. This is when you need to be scaling out, taking profits, reducing exposure even as the price is accelerating. The pattern never changes. Disbelief, skepticism, acceptance, enthusiasm, euphoria. We're somewhere between skepticism and acceptance right now. By the time we hit euphoria, the move will be nearly complete. The question is whether you position during the skepticism phase or waited until euphoria when the easy gains are gone. One more critical point: in late-stage commodity bull markets, physical availability matters more than quoted prices. You might see silver quoted at $80, but try buying physical metal. Premiums could be 30–50 over spot, delivery times could be months. The paper price and physical price can disconnect significantly. This is why building positions now, while premiums are still reasonable and product is available, makes sense even if you're not perfectly timing the bottom. I want to emphasize something about volatility because this is where most people fail. Silver is called the devil's metal for a reason. It's more volatile than gold, more volatile than most commodities. In this coming move, we will see 20–30 pullbacks that feel like the world is ending. Those pullbacks are not the end of the trend, they are the price you pay for participating in an explosive asset. The investors who make life-changing wealth from these moves are the ones who endure the volatility without panicking. They understand that sharp corrections within a bull market are normal, even healthy. They use those corrections to add to positions or at minimum, to maintain existing positions rather than selling in fear. If you can't handle watching your position drop 25% over 2 weeks in the middle of a multi-year bull market, then silver isn't for you. Stick with gold, which is steadier and less volatile. But understand that the trade-off for that stability is dramatically lower upside potential. Silver's volatility is the cost of admission for the potential 3x, 4x, 5x returns that gold won't deliver. Let me close with this. We're at a critical inflection point in the precious metals market. Gold has had its run and will likely continue grinding higher, but the real opportunity, the asymmetric opportunity, is in silver. The technical setup with the ratio breaking down, the fundamental supply-demand imbalance, the positioning asymmetry, the macro backdrop, all of these point to a significant repricing event underway. This doesn't happen often. Once or twice a generation, you get setups like this where the risk-reward is so skewed in your favor that the rational decision is to take a meaningful position and hold through the volatility. We're in one of those moments now. The question is whether you have the conviction to act on what the data is showing, or whether you'll let fear, doubt, and the discomfort of volatility keep you on the sidelines. History suggests most people will hesitate, rationalize, wait for the perfect entry, and end up either not participating or buying near the top after the move is obvious to everyone. The opportunity is here now. The setup is clear. The move has begun. What you do with that information is entirely up to you, but understand that the window for easy entries is closing. As this trend matures, entries become harder, volatility increases, and the psychological challenge intensifies. If you found this analysis valuable, if you are thinking about how to position for what could be one of the great commodity trades of this decade, leave a comment and tell me how you're thinking about silver exposure. Are you already positioned? Are you building a position? What's your target allocation? Share this with anyone who holds gold or who's thinking about precious metals. And subscribe because we are going to keep tracking this silver thesis as it unfolds throughout 2026 and beyond. This is the type of setup that defines investing careers. The question is whether you recognize it in real time or only in hindsight. The roadmap is clear, the opportunity is significant, the risks are manageable. Now it's about execution, positioning appropriately, managing volatility, and having the discipline to hold through the uncomfortable parts of the move. That's how generational wealth gets created in commodity cycles.